I want to welcome all of our investment partners here and extend a nice warm welcome to anyone new to FNRP. It's really great to have you on today. Now, given the current state of the economy and the landscape out there, the fact that inflation is always a hot topic in real estate, we thought this would be a perfect time to put on this kind of webinar. So hopefully we can send you away with a better understanding of the topic and some strategies to capitalize on the current trends. Now, before I get into the presentation, we have the usual legal disclaimer here. Bear with me. This presentation is for informational purposes only and should not be considered a solicitation to purchase securities. This can only occur via private placement memorandum. Past performance is not an indicator of future results. There's an element of risk in any investment. You could potentially lose your principal. FNRP can only work with accredited investors with income and net worth requirements as shown on the screen. Lastly, we've made every attempt to disclose real and actual figures, but no warranty or representation is made to their accuracy, and terms are subject to change. All right, thank you. This is me. I'm not going to read my own bio here, but I'm a managing director at First National Realty Partners. Today, a quick agenda. We'll define inflation, discuss the impact it has, and how it relates to you as an investor. Finally, we'll have some Q&A with my partner at FNRP, Mike Law. So if you guys are ready, let's go ahead and dive right in here. So first, what is inflation? Let's get clear on what it is exactly. As I'm sure everyone knows, the common definition of inflation is simply rising prices. And another definition that I personally like a bit more is that inflation is a decline in our purchasing power per dollar. It can also be thought of like an invisible tax. Or, ironically, you might know as inflation by a different name, at least when it's sector specific, as appreciation, which you may have benefited from any property you have owned. Now, the bad news is, if you ignore inflation, over time, it's a very reliable destructor of wealth within certain asset classes, most notably fiat currency or owning interest-earning debt. So there's no question that inflation needs to be accounted for when making investment decisions. The good news is, once you're aware of inflation, there's several ways to position yourself to make it work to your advantage. And we're going to get into some of those strategies here very shortly. But first, I want you to take a look at this graph here. It shows that if you had $1 million in purchasing power in 1971, and you decided to play it safe in the traditional sense, and you just parked that million in a no-interest savings account. Well, your $1 million of purchasing power in 1971 would be equal to less than $140,000 of purchasing power today. So playing it safe would have netted you over an 85% loss in purchasing power. Now, what's happened in the past 2 years is that inflationary pressure has been greatly accelerated by COVID and government and central actions around the globe. In case you need any specifics, you can take a look at this slide here. Overall, inflation up about 7% year over year, according to the latest numbers issued earlier this month. You probably heard milk has gone up 23%, coffee up 18%. Now, for most people on this call, milk and coffee being more expensive, you might not even notice, or at least it's pretty easy to shrug off. But this pattern is really playing up and down the line with much more impactful items. You see gas at 85%. And you take a look at lumber there. Of course, lumber is essential for new real estate development. Well, it's up 65%. Now, remember this one because we're going to come back to this later. Of course, maybe lumber does come down some, maybe it doesn't, but even just a spike like this has a considerable and long-lasting ripple effect in the economy. The point is, it's very clear that prices of all types of commodities up and down the line are going up much faster than in years past, which means that our purchasing power per dollar is going down just as quickly. So, are we in inflationary times? The general measure of how broad the decrease is in our purchasing power is the CPI, or Consumer Price Index. I'm sure you know this, which showed a 5% year-over-year increase as of May. That figure has since gone up to 7% for the numbers released this month in January. So, not only is inflation well above historical averages, but its pace is accelerating. Historically, 7%, well above average. It'll do a lot of damage to anyone not hedging against it, but only about halfway to the highs seen in the 80s. So there's a lot of room for inflation to run. You know it, I know it. Essentially, the horse is out of the barn, so to speak, and inflation is on the rise. One important thing to note is that this has even come at the surprise of the Fed, who made news not too long ago when they officially retired the term transitory when discussing inflation. Now, that's pretty telling, and that should definitely make your ears perk up. So, now that we've established inflation is happening at what most would consider an accelerated pace, let's take a look at what's causing the acceleration. As you probably heard, pent up post pandemic demand and consumers being flushed with cash from government stimulus. The increase in demand for goods is very predictably causing a shortage in supply, more dollars chasing less goods. It's really Econ 101. Demand will go up and supply will go down. If that happens, prices are going to rise. Now, this all comes back to central banks, not just domestically, but around the world, printing money at an unprecedented rate. There's been trillions of dollars of government stimulus put into the hands of consumers, and prices have risen very sharply in parallel. Now, the next piece of the puzzle is government borrowing. Take a look at the national debt here. In 2000, we had $5 trillion in national debt. You fast forward to right before the pandemic in 2019, and we're at 22 trillion. And right now in 2020, we're right around 30 trillion in debt. Now, the bottom line is there's been a lot of money printing going on, and it's having an effect. So, whatever you think about Keynesian economics and the actions of the central banks, it's really neither here nor there. The takeaway is that prices are going higher as a result of all this money printing, and it's greatly eroding our purchasing power. Now, this is true not only for the dollar, but for currencies across the spectrum. So, there's really no safe haven for a fiat currency. Now, you might be thinking, Drew, I have cable, I know this, but stick with me because I want to dive in to what this means to us as investors and the best way to navigate the current landscape. So, you've likely heard that in a period of inflation, there's a common ethos that says traditionally equity goes up as prices go higher and debt goes down in value. You'll hear people say inflation is bad for the economy, and ultimately I'd probably agree with them, but all you can really do is accept that it's happening and try to make it work for you as an investor. Now, really, the goal of central banks and governments long term should be deflation. After all, more people with more purchasing power is a good thing. It means everyone is richer, better able to provide for their needs. It's really a sign that the economy is becoming more efficient. Again, though, opinions don't really matter. What's good for the economy in a personal sense really just depends on what you're invested in. And currently, we're in a period where being in equity is really the only way to keep up. If you're on the other side of the fence and you're lending money or buying government bonds, or you're just holding cash, well, you're actually losing money. That's not where you want to be. In periods of inflation, the stock market can do very well, which I'm sure you've all noticed over the pandemic. There's been a considerable dip this month, but nothing compared to the 18 months prior. Record returns during a worldwide calamity. It's pretty strange if you don't understand the fundamentals, I would admit that. Now, this all ties back to the cost of milk and lumber going up. The value of the stock market from a dollar standpoint has become higher and the stocks have become more expensive, just like milk and lumber, because there's more dollars in the system and therefore more demand. So, what is the best way to position yourself as an investor during times of high inflation? Well, the thing is, as I mentioned, you want to be an owner, not a loaner. And the reason is, when you lock in your return rate, let's say you buy government bonds, which is loaning the government money, or you hold private mortgage notes or any other debt asset, you're locking in today's value of those returns for years into the future, or the purchasing power of those returns will be much, much less. You don't get to ride the tide up with inflation, so to speak. Your returns are chained to money's value in the year that you locked in your terms, and inflation will eventually put you underwater. And that's a really bad deal. During an inflationary period, it's best to own assets and equity, and it's bad to own debt. Because the price of the asset you own inflates with everything else. You ride that tide up with inflation. Now, at the same time, the price you pay to own the assets, be it dollars invested or payments on a fixed interest rate loan, well, they're fixed for the duration. Those payments don't inflate, and they cost you less in purchasing power due to inflation. Now, that creates a fuse burning at both ends, where the debt that you borrowed costs less and less in terms of spending power, but as inflation happens, your asset is worth more and more. This is really how you want to be set up in times like these. So hopefully that makes sense. The key in an inflationary environment is that you want to own equity. You want to be an owner and you want to have assets. You don't want to be involved with bonds or lending money because as soon as you lock that in, you're never going to do any better. For example, let's say you go and buy government bonds at a 1.5% or a 1.8 interest rate. You're never going to do any better than that 1.5 or a 1.8%. That's just as good as it gets. If inflation is 7%, well, you can do the math. Whereas if you own equity, well, you've got the ability to have some price appreciation. You have the ability for your cash flow to go higher as well. While your loan payments, well, they remain the same. You ride the tide up and your assets keep pace. It's really funny in real estate, everyone's looking for high appreciation areas and properties. Well, really, appreciation is just sector specific inflation. A lot of people will tell you inflation is bad, and then the next moment they'll tell you, well, their house appreciating, that's good. So I want you to think about what that says about how you should invest. So take a look at the second bullet here. In real estate, a very important figure is the net operating income of a property, the NOI. One reason you get to keep up with inflation, or one way to keep up with inflation, is to link your NOI to it. Now, there's multiple ways to do this that are built into the real estate system, assuming you're an owner, of course. For us and most commercial real estate property owners, rent increases are built into our leases. Most of the leases that we do with our national tenants, they have built-in escalators in their rents, specifically to allow us to keep up with inflation. This is standard and it's expected. Now, with triple net properties, we're able to offset inflation on expenses like taxes and maintenance because the tenant pays them no matter their cost. So, real estate is a great way to make sure you're on the right side of the fence and you can ride the tide up when inflation is present. Now, what you don't want to be is a loner in terms of inflation, where your returns are fixed, essentially chained to the sea floor during that time when the tide is rising. And real estate is just a great way to ride that tide up and provide a lot of security and value. So next, I want to hit on some inflation hedge myths. So during inflationary periods, people often flock to gold, or on a broader basis, commodities. And while commodities like gold might be a good store of value, in our opinion, they're not really an investment, or at least not a very good one, primarily because they don't produce any cash flow. Now, when you buy gold, you're speculating that the price is going to go higher and higher. That's not the same as owning part of an ongoing business or a piece of real estate. So commodities, while they may hedge and keep pace with inflation, that's really all they're going to do. They're only a store of value, and you're never going to have any cash flow from them. Now, perhaps it's semantics, but we don't see gold or commodities as an investment, at least not in the same way that real estate is. Same story with TIPS. You've probably heard of these. These are Treasury inflation-protected securities. Really in name only, though. I asked Jared, our Chief Financial Officer, to take a look at where TIPS are trading right now. These are government bonds that supposedly keep up with inflation. Now, on a short-term basis, these are actually yielding negative results, almost like European bonds. So if you want to go into gold where you can't generate, do you want to go into gold where you can't generate any cash flow? Do you want to go into government bonds that supposedly keep up with inflation but are negatively yielding, all while the price of lumber is up 65% and gas is up 85%? Now, to us, that just doesn't make a lot of sense, which brings me to my main point here, that in our opinion, the ultimate hedge against inflation is necessity-based or essential triple net commercial real estate. So the first thing is, and I touched on this just a bit earlier, that on triple net leases, 99% of the time, we pass expenses on to our tenants, no matter how much those costs have inflated. They pay us the base rent, and then they also pay triple net charges. You're probably familiar with this. That covers taxes, insurance, maintenance, and utilities. So what this allows us to do is offset any increase in these costs. So if taxes go higher, the tenant pays for the increase. If electricity goes higher, we're passing that through to them. If maintenance and repairs go up, they're going to pay that as well. So we have this nice little offset that allows us to protect ourselves against increases. Whereas if you own an apartment building, let's say you own an office building that's not set up in a triple net structure, if expenses inflate 7% a year, that's going to come directly out of your cash flow. When you own triple net real estate, you're able to pass that through to the tenant, which is really huge. Additionally, I mentioned built-in rent increases in leases, and this is a wonderful perk to real estate. Now, most of the leases that we inherit and almost every lease that we execute has a built-in escalator. The amount varies, but a lot of times the increase is quite significant. 10% really isn't unusual, and this allows us to keep up with or even outpace inflation. Now, the last three and four bullets, those kind of go hand in hand. When you buy a bond or you're loaning money, you're in a fixed income investment. You don't have any ability for asset appreciation, and appreciation is really just what everyone calls inflation when they benefit from it. So let's say you buy that bond that yields 2%, you return 2%, even if inflation is 7, 10, or 12%. It's just not a very good deal. So the beauty of triple net real estate is that our assets appreciate right along with inflation, while the expenses are paid by the tenant, and we can build escalations into the lease to make sure returns are keeping pace with inflation. That's an incredibly potent hedge, much more so than bonds or commodities like gold. So that's really why we like essential real estate so much. Now, I keep saying essential or necessity-based triple net real estate, and I know I haven't really explained that yet. So, our focus as a firm is on grocery-anchored real estate. That's really our bread and butter. But the same applies to other essential triple net real estate. That could be medical offices, it could be essential industrial. The key is that the properties provide something that the public is always going to need, rain or shine. And those types of real estate are comparatively very sheltered from economic downturns. We had a lot of drug and grocery stores in our portfolio during COVID. Their sales were up 20 or 25% during the pandemic, and we were just incredibly grateful to be involved in that asset class. Now, we talked to a lot of multifamily owners. They were dealing with eviction memorandums, hotel operators. I mean, they were at 5% occupancy. And it really became clear how durable essential real estate is, faring so well during such a grueling stress test. So, necessity-based real estate are very unique in its ability to do well during both times of high inflation and during recessions when they do come around. So, let's talk about how to find great deals in essential real estate. First, obviously, you can own and operate personally. That is an option. But owning and operating those assets is kind of a different animal. That's certainly not a passive investment. You're buying a job and you're operating a business. Now, a lot of us here own and run businesses. Operating a piece of real estate really no different. It requires skills that must be learned, systems, contacts, and daily efforts to keep everything in line. So buying properties directly, that's kind of in its own category, somewhere between a business and an investment. Now, the other three ways you see here, those are all passive. Public REITs and private REITs, they'll benefit from inflation, but one caveat to them, they lack a lot of the tax advantages. You won't benefit from depreciation with a REIT, and your 1031 privileges are much more complicated and restricted. REITs are also liquid, which means they're much more volatile than investments with longer lockups like commercial real estate. And that's due to the instant price discovery. And REITs are also becoming much more correlated to the broader stock market. So that leaves private equity deals or private equity deals that break down into funds. And the beauty of these is that you get the full advantages of private real estate. You get the benefits of keeping up with inflation, you get the tax benefits, you get the easier 1031 ability and privileges, the cash flow, the appreciation, and they're completely passive. No calls about frozen pipes or leaky roofs. So it's because of these reasons that we think private, essential, grocery-anchored centers are really the best-in-class investment out there, and doubly so in times of high inflation. And that's what we specialize in here at FNRP. Now, today's call was about inflation, not us, so I don't want to go crazy here, but let me give you a quick overview of our firm and how we work. We're a vertically integrated, opportunistic, value-add private equity sponsor. We're based out of Red Bank, New Jersey, but we operate nationwide. We have just over 7.1 million square feet in our current portfolio, properties all over the country. We've worked on over 40 million square feet of deals collectively. Our leadership team has over 81 years of experience and has done over $10 billion in deals. Now, we have 90 of the best in class on staff here at FNRP. We made the conscious decision to optimize for competence over location, so we hire the best that we can find from all over the country. They work amazingly hard. They're an incredible group. You can read everybody's bio on our website at fnrpusa.com. And then finally, a few things that make us unique in this space. Our Dragnet acquisitions model, our investment thesis, tenant-centric value-added investing, and our asset management approach FNRP 360. And I want to touch on each of these just briefly here. Now, the first would be our Dragnet acquisitions model. This is how we vet our properties. We've developed over 60 specific boxes that need to be checked before a deal even makes it to our investment committee. And if it doesn't have all those boxes checked, we're not going to move on that deal. Consequently, in order to source enough deal flow to find opportunities that check all those boxes, we take a nationwide focus. We leverage our relationships with the brokerage community, the institutional seller community, and the family owner seller community to source our deals. And we run this dragnet across the entire country. We evaluate thousands of both on and off market deals, nearly all of which fall out of our pipeline for one reason or another. Perhaps the anchor tenant sales aren't good enough. Maybe there aren't enough national tenants. The population density isn't strong enough. Maybe the returns don't make sense at a certain price point. The point is, deals, we're going to kick deals out of that pipeline for a lot of different reasons. And after taking all those factors into consideration, we're hopefully left with one deal that we believe offers the highest returns with the absolute lowest risk possible. We really do look for that asymmetrical risk and reward ratio. It's hard to find, but it is out there. We have a saying here that's kind of become our North Star of sorts that guide our acquisitions, that we look at 1,000 deals and we choose one. And that's always served us very, very well. So here's some of our recent acquisitions that did meet our criteria. You can see a Food Lion in Fayetteville, a recent Kroger deal, a couple Kroger deals in Michigan and Georgia, an Aldi in Pennsylvania. You can check out our entire real estate owned schedule, our REO schedule here. I know this is very hard to read. We have about 50 grocery anchored properties in 19 states currently, altogether valued about $1 billion. So now the second thing that makes us unique is something called tenant-centric value-added investing. And really, that's just a fancy way of saying that we use our tenant relationships to add value at the real estate level. And the first benefit comes from an intel standpoint. When we're looking at a deal and we see Kroger, for example, well, we already have 7 or 8 other Kroger deals in the portfolio. We have a great relationship with them. We can get to them very quickly. We know the heads of real estate there, and that is a huge advantage. Now, we've cultivated relationships with most of the major player national tenants, and that really helps us get the scoop on a deal very quickly and know if it's right for us or not. So having these relationships gives us a tremendous amount of intel. Now, the second thing we're able to do is lease up space very quickly, frequently even prior to closing. We just did a deal, the Crossroads deal. You might have seen the emails or had it come across your desk, but we had 4 letters of intent and 2 leases signed before we even sat down at the closing table. So these national tenants, they really prefer working with a company like ours who operates nationwide and could show them multiple opportunities within the portfolio. We have a lot of national tenants, and that's by design. Here's just a small slice of our current tenant roster. It's a much longer list, just a few highlights you see there. Let's see, and the final piece that makes us unique, something called FNRP 360. That's another way of saying that we're a vertically integrated firm up and down the line, from acquisition to disposition. So whether it's accounting, property management, legal, leasing, asset management, acquisitions, dispositions, or debt origination, we've made the conscious decision to bring every single function in the commercial real estate process under our own roof. Because in the end, we really feel that nobody cares about our properties or our business more than we do. We go out of our way to hire the best of the best people we can find across the entire country to help us execute all these functions up and down the line. And there's really no question this maximizes asset performance and really improves our returns. An honor and a pleasure to work with such a competent and passionate team. And that's why we've coined our insourcing process, FNRP 360. Now, before we go to Q&A, we actually do have a deal in the pipeline that we're working on. We're projecting a 15% total annual return. That's on a 5-year hold on a Randall's anchored center in Houston. Randall's is an Albertsons brand, if you're not familiar, and Texas, great place to invest right now for a lot of reasons. We've already purchased the property for $45 million. These are our projected returns for the deal, targeting a 15.1% annual return. Now that's cash distributions plus the upside. And from a distribution standpoint, we're looking at a 7% blended cash flow over a 5-year hold. And that all sums up to a very nice 1.9x equity multiple on invested capital. In other words, almost doubling the investments during the 5-year period. So we look at a hypothetical $1 million investment here. As I said, a 15.1% targeted annual return. So on $1 million, about $150,000 return on your money total per year. That includes both distributions that our firm pays quarterly and the upside paid out at sale, all averaged out over the 5-year hold period. So, from a distribution standpoint, how much of this will be paid out in those quarterly distributions? We estimate a yield of 7% for average annual cash distribution. So, $1 million investment will net you $70,000 per year paid out quarterly. So all that adds up to an equity multiple of 1.9. You put $1 million in, we project to send you back 1.9 million. These are exactly the kind of numbers we're looking for in this kind of deal. And of course, our projected numbers, we really do like to underpromise and overdeliver on these deals. Just the best way to do business. But we believe that we're getting a really great buy here. Now, keep in mind, this doesn't include any of the tax benefits associated with this deal, which are really phenomenal for commercial real estate. But of course, that's probably a webinar for another day. So if you'd like to know more about FNRP and this deal, you can go to fnrpusa.com/call and schedule a call with my partner, Ken Chapman. He'll go over the entire deal with you prior to the actual webinar launch, which is coming up. And again, this is fnrpusa.com/call. Ken will get you filled in. Be more than happy to take all the time you need. I know we had a great turnout today, so thankful for everyone being here. Time, really the most valuable resource, and it's an honor to have some of yours today. So questions and comments, we'd love to hear from you, fnrpusa.com. Now I'd like to hand it back to Mike for some Q&A. I think we just have time for a few questions, but don't hesitate to reach out to Ken's team if you have any more. Mike, are you still with us?
Mike, you're...
Hey, Mike. Yeah, there you are.
Hi, Drew. Great job. And Jeremy, how much time do we have for questions?
Yes. The first one we had was, how has inflation affected your current deals and the returns?
How has inflation affected our current deals and returns? Well, first, I would just want to say, Drew, great job on the presentation, and thank you everybody for attending. My name is Mike Law. I'm one of the managing directors here at First National Realty Partners. I've been with the firm for about 3 years, and I've seen us run maybe 30 or so transactions, through our company in that time. To address the question, how's inflation affected our current deals? The answer is it really hasn't significantly yet. I mean, we were seeing the big spike in inflation came out in December. What's more important is really how we're kind of positioning ourselves for it moving forward. And the strategy there for us is to include rent escalations in all of our leases, as many as we can possibly negotiate. And then also, we realize the advantage of a triple net lease structure with a lot of these guys, where we're passing the expenses for the property onto the tenants, which really kind of hedges us from cost increases and also insulates us on the income side of the balance sheet as well. So I hope that answers your question.
Okay. We're short on time, so I got 2 more questions. One was, do we have leases with a percentage of sales to help further inflation hedging?
We do. So when we're acquiring a new property, a lot of times, we're inheriting the leases that are in place already. And so many of those will not have an escalation built into them. Some of them do. Some of them may be near the end of their term. And so part of what we do is, we'll negotiate lease extensions with these guys that will include percentage of sales leases sometimes, or they'll include rent escalations whenever we can. It's a negotiable, and so it's it's just kind of part of our strategy that our leasing team executes whenever we acquire a new property. In terms of the leases with percentage of sales built in, if you're not familiar with that, basically what it is it's a rider on the lease that allows room for higher rents in the event that the tenant performs well. So it's a negotiable with each lease. We don't put those on all of our leases. It's a negotiable that we use, but it's a great tactic. We try to use it whenever it makes sense. In some cases, one of FNRP's strategies is to, we have relationships with a lot of national tenants throughout the country. As Drew showed on one of the slides with the national tenants, we have relationships with these, national directors of real estate, and we will oftentimes negotiate percentage of sale increases with them and apply those across all of our properties. And especially when we're, assuming a new lease. So great question.
All right, and here's the last one. Have y'all had any issues in collecting rent this past year with the pandemic and rent deferments?
With the past year, no. When the pandemic started, we did see a couple of months of, some uncertainty, especially with the local tenants. Generally, we're filling or when we're acquiring property, our strategy is to look for about 65% or so of national tenants in a center. And, we're looking at the number 1 or number 2 center in a submarket, always with a strong performing grocery anchor. And so what we saw during the early days of the pandemic was some abatement requests that came from more of the local tenants, your mom and pop restaurants, your craft stores, your health food stores, stuff like that are owned by, local shop owners. They saw a lot of uncertainty, and, we honored that. But since I would say about the summer, maybe June, July timeframe, we haven't seen any, and our national tenants are actually performing better than they were even pre-pandemic. So, we've seen, as Drew mentioned, over 20, sometimes in some case 30, 40% increase in sales volume, which is attributed to also to increased foot traffic, which all of our tenants love the foot traffic to these centers. Our focus is necessity-based grocery anchored real estate. And, as Drew did a great job of outlining, everybody needs to eat. And these grocers are still driving a ton of foot traffic, even if it's, more pickup like, distribution. They're using their local, they're using their retail space essentially as their warehouse. And these, a lot of our tenants are seeing really long-term lease extensions. We just signed a 60,000 square foot Kroger on a 10-year deal just last month, 10-year lease extension. So, yeah, not a lot of significant interruption really since the first couple months. So another great question.
Well, why don't you tell us what the minimum investment is and close us on out?
All right, great. Thank you. So the minimum investment is $50,000. I can give you the, kind of the process in general. If you're interested in getting involved in our deals, you can visit fnrpusa.com/call and set up a call with our partner, Ken Chapman. Also, if you're interested in just kind of doing some passive browsing over our current offerings, visit fnrpusa.com and click on the investors tab and invest with us. It'll walk you through a real short form, and you'll be taken to our deal lobby where we showcase a number of our active offerings. The process is a 4-step easy process. We encourage our investors to find a deal that you love, one that really resonates with you. You're in love with the strategy, in love with the location, and all that stuff. We bring out a couple deals a month on average. They're all grocery anchored, all either core or value add deals, kind of different flavors in different parts of the country. And second, we definitely encourage you guys to attend one of our deal launch webinars, which once you get into our system, get on our list, you'll see email invitations for those. Next, make an allocation, reserve your spot in one of our deals. Again, the minimum investment is $50,000. We definitely encourage you to invest what you feel comfortable with. It's an illiquid private placement investment. So we want you to invest where you're comfortable. You'll never get any high pressure sales or anything like that from First National. And then lastly, I think you just enjoy the passivity of being able to collect a quarterly distribution and, kind of rinse and repeat with that process. So that's it. Again, thanks for joining, everyone. It's great to have you guys. Nice to meet all of you, at least virtually. Drew, great job on the presentation. And again, if you're interested in connecting with us, we'd love to share how you can get involved. Just visit fnrpusa.com/call if you'd like to set up a call and kind of a one-on-one. Or if you'd like to browse our deals, just visit fnrpusa.com and click on the investors tab, and it'll take you right into our deal lobby. So thank you again, everyone. Appreciate it.
Thanks, everybody.
Thank you, everybody. And that completes the webcast.